It's that time of year again when every business owner I know is getting excited. Why, you might ask? Well, it's tax season. It's the time of year when all the business owners look back at how much profit they had last year and just how well they did, and they get excited about giving Uncle Sam more of their hard earned money. So, if you're looking for some creative ways to give money back to the government, this is not the video for you. If you are looking for some great ways to save money and reduce your tax burden, then stick around and let's find out how. So typically at this time of the year, I get a lot of questions from business owners on how to reduce their taxable income. And a lot of the advice that you typically hear as an owner is to buy more equipment or to push some of your expenses from next year into this year, or defer the income that you have this year into next year. But that doesn't really solve the problem. So you still have money going out the door. You may not need the equipment. And at some point, you're going to realize the income that you deferred. So what can you do? Well, one of the simplest and often overlooked strategies is to implement a retirement plan. And you might be wondering, aren't they expensive? Or what happens if my employees aren't contributing or they don't use the retirement plan? What's really the benefit of it? Well, some good news this year is that the Secure Act 2.0 provides a credit for all small business owners that are implementing a new retirement plan. And that credit's really pretty powerful. So it's 100% of the administrative costs up to $5,000 for the first 3 years. On top of that, you get an additional 100% of the contributions that you make for an employee up to $1,000 for the first 50 employees that you have, and you don't count the employees that have over $100,000 of income. And that $1,000, it does decrease. So the first year it's $1,000, year two it's $1,000, but in year three it drops by $250 down to $750. Year four is at $500, year five is at $250, and then after that the credit goes away. But if you're looking to start a plan, it's a really great benefit. So let's take a look at an example of a retirement plan for a small business. In our example, we have an owner and 5 employees. The owner makes $200,000 a year, and each of the employees make $60,000 per year. So the owner's goal is to maximize his savings and reduce his taxable income as much as possible. So in order to do that, the owner decides to utilize a 401k new comparability plan. And a new comparability plan has some specific rules that you have to follow, in which the owner has to make some non-discretionary contributions in order to meet the minimum gateway test, basically keeping the owner from discriminating against non-highly compensated employees. So in this case, the owner puts in just under $3,500 for each one of the employees in order to satisfy the 5% gateway test. So the total cost for that are around $17,400, and we're going to assume there's about $2,000 for plan administrative costs. So his total costs for the plan are approximately $19,400. So after the credits, the overall plan cost drops down to $10,400. Now keep in mind, the cost of the plan will go up as the credits are phased out over the next 5 years. Now that the owner has satisfied the minimum gateway testing requirements for the new comparability plan, he can then make a $43,500 profit sharing contribution to his portion of the account. So if he's in a 24% bracket and has a 5% state tax, that's 29% in taxes, which now that that income is not being taxed, it results in a savings of $19,100. Now, if you want to back out the expenses for the plan and for the employees, the overall savings is still $8,700. Okay, so what else is there besides a 401k plan? We've seen that there can be some huge savings there. And as that plan continues over time, you're getting that benefit each and every year. But what else can you do? So there's actually four more things that I'd like to tell you about. So hang with me. The first one is a health savings account. A health savings account is essentially a pre-tax account that you can put money into that can be used for qualified healthcare expenses all the way up through retirement. So if you don't use the money right now, that money will continue to grow pre-tax, and you can always take it out later once you're in retirement and just pay your ordinary income taxes on it. So one of the benefits is that you can put up to $3,850 into this account if you're a single person, or $7,750 if you're a family. So there are some caveats that come along with it, and the main one is that you have to have a high deductible healthcare plan. So you have to meet some requirements for the high deductible part in order for you to be able to contribute to the HSA. But if you're a fairly healthy person, don't really see the doctor a lot, or your family is relatively healthy and your kids aren't having to go to the doctor very often, then it might make a lot of sense for you to consider that. So the next thing that I want to tell you about is the flex spending account. And remember, there's two different types. There's the healthcare flex spending account, and then there's the dependent care flex spending account. Now, the healthcare flex spending account is similar to the health savings account in that you can use it for qualified medical expenses, but the difference is the health savings account will continue to grow over time, where the flex spending account, if you don't spend it in the year that you put the funds in, you'll actually lose the money. So you have to be considerate about how much you want to put in there, but it's another great way to save money on healthcare expenses, especially if you know you're going to incur those expenses. So the amount that you can contribute for a family or individual is $3,050 in 2023. Now, the next type of flex spending account is the dependent care spending account. And the dependent care flex spending account allows you to put up to $5,000 into a pre-tax account, again, to be used for dependent care costs, such as daycare or day camps, childcare. Sometimes the babysitting will qualify as well, depending on how that's structured and who is providing the service, and also for adult daycares. So it can be a really unique tool because now you've got three different options for putting pre-tax dollars in. So if you utilized the flex spending account for the dependent care, that's $5,000. You put another $3,050 in for the healthcare component. Now you're at $8,000. And then you put $7,750 in to the health savings account. Well, now you've put in $15,000 and you're avoiding the ordinary income taxes on that money. And the last thing that I wanted to talk with you about today are some of the charitable giving strategies that are available. So you might be familiar with writing a check to a charity or giving them cash, but have you thought about donating highly appreciated stock? So one of the great benefits of donating stock is that you avoid paying the capital gains taxes on whatever you're giving. So let's say you have a stock that's worth $10,000 and it has $2,000 worth of capital gains taxes. Well, if you were to take the stock and sell it and then take the proceeds and then give the proceeds, you would be out about $400, assuming you had a 20% capital gains tax. On the other hand, if you donated the stock directly, now you get to deduct the full $10,000 without having to worry about the capital gains taxes. So the charity gets more, or the church, or whatever it may be, and you still get to write it off without paying any taxes on it. So we talked about a lot of things today. We talked about retirement plans and how the costs of those plans are not as prohibitive as you might have believed they were, and just how much tax savings they can truly bring to the table. We talked about health savings accounts and flex spending accounts and how those are different, but how they offer some really great opportunities to, again, lower your taxable income. And then finally, we talked about the charitable giving strategies where you can donate those appreciated stocks or other highly appreciated assets like real estate and avoid the capital gains taxes. So I hope that you can take these strategies and begin implementing them into your own financial plans and into your own exit strategy so that you're able to retire comfortably and with the wealth that you need. So as always, thanks for watching. If you liked today's video, hit that subscribe button, and I look forward to talking with you soon.